Investment advice I told my 25-year-old daughter. All right, so Maddie's my oldest. She's 25 years old, and she's crushing. She got a good job, making pretty good money. Hi, puppy. And, we just talked the other day. She came here and we were chatting about what to do with her various investments and whatnot. We've had this conversation a couple times a year. And I just continue to harken. I said, Maddie, just put everything into a Roth as much as you possibly can. Just fund your Roth without question, without hesitation. Put it all into your Roth. I said at some point you might make too much money where you can't contribute to a Roth. All right. So and when that's the case, don't do it into a non-deductible IRA. What you want to do is you want to put it into a brokerage account. So remember, she's only 25 years old, my friends. All right. So first and foremost, we've maximized the Roth IRA. Unequivocally, we put it all into VTI, the Vanguard Total Stock Market Index, all of it into VTI. We maximize the Roth. Part two, her 401k contributions, all into the Roth 401k. All right, and I can't remember exactly what the new rules are in terms of how much you make if the company has to put in the Roth. I can't remember how that works anymore. On your company match, does it have to go in the Roth that you make over 100,000? I can't recall. I don't think it's 100,000. I can't remember. Anyway, be that as it may, the company match, if it can go in the Roth, absolutely, that's okay. If it can't, that's fine too. But your money needs to go into your Roth 401k. Your money needs to go into your Roth IRA. Again, if you make too much money, then it would go into a brokerage account, not a non-deductible IRA, not a deductible IRA, a brokerage account. There's a number of reasons for this. The brokerage account is actually better than a non-deductible IRA, and it's actually better than an IRA. And the reason for that is because she's only 25 years old. She still has 25 years ahead of her before she has access to this money without penalty or taxes. All right, we want to build up a sizable brokerage account. Yes, it might cost a little bit more in taxes. She'll get a little bit of qualified dividends off the VTI. She doesn't get any capital gains, and we're talking minuscule. Remember, even if you got $1 million in there, I think what's the dividends right now on VTI? Let's take a look here. Let me pause. All right, right now the dividend is 1.14. All right, so even if you had $1 million in there, that's $11,000 of qualified dividend income. All right, that's just not a big deal. She doesn't have $1 million. I'm telling you right now. So you'd have to have a lot of money to have any kind of dividend consideration for your VTI. So just don't worry about that. So it's growing tax-free. There's no capital gain. All right, so Vanguard, again, I've talked about this a million times. They have some nice way they do this. And they had some kind of a patent on it where they'll have to issue capital gains. So VTI is growing just like a Roth, tax-free, except you got to pay some taxes on the small dividends that you had in there. Just not a big deal. But unlike a Roth, or especially a traditional IRA or a non-deductible IRA, the brokerage account is yours for the taking whenever you need. Why is that important? Well, let's just say she gets laid off and she needs Obamacare. And we want to be poor on paper. How can you be poor on paper if everything's in a pre-tax account? How can you be poor on paper if you got to take money out and it costs 10% penalty because it comes from a Roth? You can't. Well, maybe you could on the Roth, but still, it's going to be tough. We don't want you to pay 10% penalty. I'd much rather you pay, $1 million, $11,000 of income off that. It's taxed at, we'll just say 15%. So whatever that is, $1,500 in taxes, $1,600 in taxes today to be able to qualify for Obamacare, and on top of that, not pay a 10% penalty in the future. Does that make sense? Fund that Roth as much as you can. And that's if you're in a pretty good tax bracket. If you're a low tax bracket, it's not debatable. You fund your Roth unequivocally. If you're in frankly, if you're young, you should be doing Roth unequivocally. If you're older, maybe not so much, but without question, if you're in a 22% or lower tax bracket, you should be doing a Roth. There's no debate on that. If you're in a higher tax bracket, you might want to revisit that, but I still say do the Roth because if you're laid off, you're going to need health insurance, and health insurance is based on the income you have. And if the income you have is you're pulling money out of a tax deferred account, it's going to cost you income tax. It's going to all flow back to your AGI, and on top of that, you're going to have a 10% penalty. So you do your Roth, because remember, you have access to your principal in your Roth without hesitation, without question, without taxes or penalty. You don't have access to your gains, I grant you, but you do have access to your principal. On top of that, on a brokerage account, you have access to everything. Yeah, you might have to pay a little bit of capital gain. You might have to sell something in terms of you get a $500,000 account value that you got $300,000 basis in. All right, you might have a $200,000 capital gain. You're not going to take that in one fell swoop. You're just not. So at the end of the day, the brokerage account is where to go. All right, brokerage account's where to go. Roth first, brokerage account second, unequivocally. Your 401k always should be in a Roth. If you're young, I don't even care what tax bracket it should be. It should always be in a Roth. If you're in a lower tax bracket, it's insane not to put your 401k in the Roth if you're in a lower tax bracket. It's just insane. Don't do that. So it should all be VTI. Now, Maddie said, well, should I even have 3 months of emergency money? And, yes, you should. But this is, for me, I don't, because I like everything invested. You know what I'm saying? So my emergency fund, and this is where I kind of burned me in 2007 and 8. I had all my money. I mean, basically I was borrowing on zero interest credit cards so I could fund my Roth. I had 4 young kids and my wife wasn't working. I think she's working part-time as a bank teller or something like that. I was working a part-time job on top of my regular job. So we didn't have a whole lot of disposable income, not enough to fund a Roth. So what I'd do is I'd take out whatever it was back then, $5,000 and fund Charlotte and my Roth IRAs. And I'd transfer it to another credit card at 0% interest. That worked like a charm until the markets fell 57%. The debt wasn't really called, but they said from 0% to 14.98% interest. I was like, what the hell? And anyway, so that kind of sunk me. I was like, damn. So that was a mistake. But yeah, at the end of the day, you still want 3 months of cash or so, 100%. And it's just, for me, that's what I told her too. I said, yeah, I almost hate to do it, but it's just having that cash on the side. You'll always be happy to have cash. That's just a fact. You won't be sitting there thinking, man, I got this debt on my Roth. My Roth is funded by debt, and the Roth is now down 57%. I lived through it, man. I lived through it. Learned from my mistakes. Anyway, so that's how I told her to invest. 3 months cash, in her local savings account, high yield savings account. Everything else in Roth and VTI. Then you're done. All right, God bless. Love your thoughts. See ya. Wouldn't want to be ya. And Pablo says, woof, woof.